Oh boy, finally, we've gotten to our last presentation in mutual funds. A lot of information, dear students, but it's important information, especially for you rising investment gurus. And in our last presentation, we're going to discuss a few odds and ends. We'll take a look at some fund families, realizing that there are dozens. And then we'll take a look at some of the services that fund families and mutual funds offer to their investors, how to find information on mutual funds. And finally, we'll ask the question, so how do I pick a mutual fund? And then we will key in, we will focus in on just one mutual fund out of 12,000. Because we got to start somewhere, right? And we'll see that if we choose a prudent, long-term oriented mutual fund that has done well in good times and bad times, the news is good. We can build substantial wealth. And we really don't have to do a whole lot, except choose our mutual fund. The rest is up to the mutual fund managers. So let's get started on slide 62 with fund families. A family of funds exists when one investment company manages a group of mutual funds. Up until the 1960s or so, most companies had one, maybe two mutual funds. But then competition, exactly. One company created a new type of mutual fund. The other companies had to follow suit until you finally have these mutual fund families with dozens, hundreds, some have hundreds of mutual funds. Now, of course, the funds in the family vary in their objectives, although sometimes they're so similar it's hard to tell the difference. You can move your money from one fund to another within a fund family, almost always with no charge. If it's in a taxable account, though, you're going to generate a taxable transaction because the IRS says, hey, you had fund X in this family, now you have fund Y in this family. You've gone from a growth fund to a bond fund or whatever. That's a taxable transaction. And if you do it excessively, now what's that? It depends on the company. But remember we talked about the people who are selling it one day and buying it back another day? If you do that, companies will sometimes just stop you from doing it. They won't let you. Some companies like Vanguard, like American, they just say, no, you sold it, you can't buy it back for 30 days or 60 days. Other companies will say, sure, you can do that, but we'll charge you 2%. It's trying to discourage people from market timing, from doing those things that they were doing in the late 1990s, early 2000s. And they take that 2% and give it back to your fellow investors, your fellow mutual fund investors. So again, mutual funds are a long-term investment. Don't time the market. Don't play games. Don't trade mutual funds. If you want to trade mutual funds, that's what you can do with ETFs. But I submit to you that it is not in your best interest. Your broker will love you. But my commissions are free. Wrong. Wait till we get to chapter 3. And Forbes said it best. I wish I had said this. Back in the 1990s, I think they said, choose a family, not a fund. Because you find some people who just, whatever the reasons, they read something, see somebody on the television or watch or internet or watch an advertisement that turns them on. They'll have 17 mutual funds across 4 or 5 or 6 different fund families. And you think, come on, if you do that, you're way too diversified, okay? You've gone way too much because a mutual fund by definition, a good, well-run mutual fund is already very well diversified. So choose a family, not a fund. And come on, sweetheart, let's go to the next slide. Here are the top 10 families. Well, not really. Why? Because this information is kind of hard to find, and some other sources have the top 10 listed differently. And this is from September 2019, so it's kind of old, considering that 2020 and 2021 were pretty darn good years. So this is where I'm falling down the job. I'm not the best data researcher. I would have thought that the ICI.org, the Investment Company Institute, would have this information, but I guess they don't want to step on people's toes. And sometimes what'll happen is you'll see BlackRock ahead of Vanguard. And that's not true. BlackRock is the world's largest money manager, but they're not the world's largest mutual fund company. They have other products that they offer, and they are the world's largest money manager, but they're not the world's largest mutual fund company. That is Vanguard, and Vanguard has really parlayed their index funds into being the top and low fees into being the top mutual fund company. But BlackRock's not far behind. And then we have the company that used to be the largest company, and that's Fidelity. And they're not all standing still, but obviously Vanguard is pulling in the major shares. People just have been convinced that Vanguard is on their side. Well, maybe sometimes, yes. And if they really did believe that index funds were the only way to invest, why do they still have Wellington and Prime Cap is what I would ask them. And if you don't know what I'm talking about, don't worry about it. American funds, they've been called American funds for decades, but they're really the Capital Group, so they're trying to reclaim their original name, and that's Capital. And they've been around also for decades. So you notice that they are the top four, and of course Vanguard's way ahead of the others, are pretty large organizations, right? And again, this is old data because it's more money now that the market's done very well the last 2 years. State Street Global Advisors, very interesting company. They are a company that started out as remember the custodians and the trustees and the like? They would do that for other mutual fund companies, and then they decided, hey, we're going to start our own. And so they're the ones who are one of the big ETF companies, ETFs. And so is BlackRock. They're big on ETFs. But so is Fidelity and Vanguard too, so everybody's getting in on the act. T. Rowe Price is a company based in Baltimore. By the way, Vanguard's based outside Philly. BlackRock, I think, is in New York and Boston. Fidelity's Boston. American Funds is Los Angeles, if you can believe that. State Street, Boston. But remember, these are global companies now. T. Rowe Price is based in Baltimore, and a very good company, by the way. They were one of the first mutual fund companies to go abroad. So they're based in Baltimore. You say, no, they're globally based now. Invesco merged with a company called Oppenheimer, which Oppenheimer had some very, very good funds, and I think they're getting rid of the Oppenheimer name, and it's all Invesco now. By the way, they're based in Denver. Dimensional Fund Advisors, DFA. Now, I'm not sure where they're based, but they're very popular with advisors. They have some really dynamite funds, and you would typically get their funds through an advisor. So they cater to the advisors. And PIMCO, Pacific Investment Company, based in Newport Beach, if you can believe that. And they had at one time the largest bond funds in the world, and had one of the best bond fund managers, but he left a while ago. And then Franklin Templeton, an excellent company based up in the Bay Area, as I remember, California. They have since merged with that company we talked about in the second presentation, Legg Mason. And I'm not sure if they've made some great decisions, but they've had some great funds throughout the years. Now, we want you to check out some of these funds. Obviously, and this is just the top 10. There are dozens more fund families. But I really like 6 of them. And if you go to the website, and it's also on Canvas, you'll see that I give you the websites for 6 of those top companies. Actually, Dodge & Cox is not one of the top 10, but it's a very good company, and I really like them. So I like all 6 of these companies. 4 of them I really like. And so that doesn't mean you should invest with them. It just means there's a great place to start. Take a look at the offerings and their performance. Take a look at their prospectus, which we'll talk about in a few minutes. And then you can also go to their websites and listen to and watch and read what they believe is going on in the markets, insights, perspectives, commentaries. It used to be that they started when the internet was young in the late 1990s. They started doing great things. Vanguard had this Vanguard University, which was awesome. It really was a great resource. And then in the 2000 to 2003, 2002 bear market, for some reason, I guess the SEC came down on them hard and said, we don't want you doing this. I don't know why, but they they just disappeared, right? And now they're back again. So Dodge and Cox, American, Vanguard, T. Rowe Price, Franklin Templeton, they all have very, very good insights that you can watch, listen, and read about. And you'll see that many of these people are very good at what they do. Some are not so good. They all have very good funds, all these companies. And the one I'm not, Fidelity has too many funds. That's my opinion. They just have too many. And so they really need to rein it in, but they haven't. They're a very good marketing organization. They do sip from the fire hose. They just give you dozens and dozens and hundreds of funds. And you're kind of going, well, where do I start? Well, that's the problem. Fewer choices. And that's why I really like Dodge and Cox. Dodge and Cox says, hey, we got 6 or 7. That's all you need. And they don't even have a money market fund. So they're like, yeah, you got your bank. That's good enough. You don't need us. And so everybody, that's why the industry is just so much fun, because it's just so immense and there's no end to how much you can learn. So in the face-to-face class, we would then take a look at some of the offerings and show you Vanguards typically I show you Vanguard, Fidelity first, because they have 500 funds. And then Vanguard has a couple hundred. And then I show American funds. And why I do that is because they have enough to fit on one page. So I show you their funds, but then I show you what happened in 2008. And they actually held up better than most companies, but it was a bloodbath. And so the idea, folks, is to make you understand that it's volatile. You don't want to load up your plate all with the hot, spicy, aggressive growth funds. Because what's going to happen, not to you, but to other people, this happens. They look at the mutual funds that are available to them. They say, great, this one's done 13% over the last 10 years or 16% or whatever. That's the one I'm going to go to. Right when the market hits. Ooh, is it too late to get in? Right when the market hits its peak, and then the market falls, whatever, and the aggressive growth fund falls 60%. And is it too late to get out? And exactly, they then take their money out, put it in the money market fund, just in time for the market turnaround, jump 30%. That's why we want you to understand that you want to be somewhere in the middle. Put a little bit of spice on your plate, but put the majority in the middle of the road. I like growth and income, global stock funds for most younger folks. As you get older, you might want to add some bond funds, maybe a balance fund. But relax, because the news is good, as we'll see. So let's continue. Some of the investor services. Mutual funds are extremely convenient, folks. The automatic investment plan, whatever you want to call it, it goes by the name dollar cost averaging, which is a horrible name, but I've tried to come up with a better name. Systematic investment plan, SIP, I don't know. But these are mutual fund services that allow shareholders to automatically send fixed amount of money from their paychecks and bank accounts into the fund. So from your payroll or from your checking account, pay yourself first. We talk about that in the BUS123 Financial Planning and Money Management class. In my humble opinion, this is the absolute best way to invest in a mutual fund. You don't have to worry about whether or not it is a good time to invest. Every month is a good time to invest $50 or $100 that comes right out of your paycheck or checking account. And folks, it's practically the only way that most of us working grunts are ever going to invest, right? How many people will say, well, I want to wait till I got $5,000 and when are you going to get $5,000 lying around the house, right? Start putting $50 a month away in a well-run, prudent, long-term oriented growth and income mutual fund that invests all around the world, and hope that the world doesn't end. The next category of investor services is the reinvestment plan. And this is automatic. You don't have to worry about this. Unless you ask for something different, the mutual fund will enable shareholders to automatically buy additional shares in the fund through reinvestment of dividends, interest, and capital gains. So what's going to happen is they're going to distribute some earnings, some dividends, some interest, some capital gains. And instead of sending you a check, they're going to turn around and buy more shares in the fund. And unless you tell them differently, that's the default. It allows an investor to earn fully compounded rates of return. Unless an investor needs the income, it is always a good idea to reinvest dividends and capital gains received from a mutual fund. And as we said, that's the default. When you open up the account, be it a regular account or a retirement account, that's what they're going to do unless you tell them differently. And then lastly is the way to get the money out, the systematic withdrawal plan. This is the service that enables shareholders to automatically receive a predetermined amount of money monthly, quarterly, semi-annually, mostly monthly, right? That's going to be your new paycheck. You set it up so that it is electronically directed, transferred directly to your checking account. Is that cool? So here's the deal, folks. This is the deal. You're young, right? Start putting $100 a month away, $50 a month away. Increase it as you can, as you pay down debt, as your salary raises, as it goes up. You do that for 30 or 40 years. And then you're going to take $2,000, $3,000 a month or more out of your mutual fund investments, your 401k, your Roth IRA, your regular account for the rest of your life. Is that a deal? You are young, right? If you're older, then it's a little harder to do, as we're going to see when we take a look at some of the illustrations. But it makes investing boring. That's why we say mutual funds will bore you to wealth. But it works. And it takes emotions out of the equation. Remember, investing is simple, but it ain't easy. If we set it up so that it's automatically paid to the mutual fund every month for 30 years, 40 years, now you're going to raise it every once in a while, maybe move things around a little bit, but for the most part, forget about it. Hey, and then take it out for the rest of your life. I think so. The conversion privilege, the exchange privilege, we already made mention about. This allows you, the shareholders, to move money from one fund to another within the same family of funds and not trigger any costs, no further costs. But if it's not in a retirement account, the IRS is going to say, hey, you owe us, it's a taxable transaction. You owe us taxes. Or maybe it's a loss. I don't know, we hope it's not a loss. But that's the conversion privilege. So how do we purchase our mutual funds? Well, if they're closed-end or ETFs, you have to do it through a stock exchange. You have to have a brokerage account. And we said that some of the mutual fund companies like Vanguard and Fidelity have their own brokerage firms, and if you buy their ETFs through their brokerage firm, they don't charge you any commissions. The open-ended, you can do it through a broker, you can do it directly from the investment company, but again, in my humble opinion, automatic contributions from your payroll, from your checking account. And the same thing is true for the sell options. If it's a closed-end, an ETF, you have to go through the stock exchange for your brokerage account. If it's open-ended, you call up your broker or you go directly to the mutual fund company website. And in my humble opinion, the best way is through automatic withdrawals directly into your checking account. Cool? I think so. Now, taxes. Oh, darn. We have to worry about taxes. Yeah, we need to keep taxes in mind, but taxes should not be the tail that wags the dog, so to speak. There are two types of taxes for regular accounts. There's the income dividends, which can be taxed as income depending on your situation, but typically are taxed as capital gains distributions, which means 20% maximum, 15% typical for the vast majority of us, and 5% for some people, depending on how much money they make. And that's the same is true for capital gains, assuming they're more than 1 year. And if you take a tax class, you'll learn all about how taxes are computed on investments and the like. But typically 15% for the vast majority of us working grunts. Reinvested dividends and capital gains are still taxable transactions. Now, what did I just say? Remember, we said that the mutual fund is going to automatically purchase more shares, But if it's in a regular account, that's still a taxable transaction. You still get a 1099 from the mutual fund company saying that you made this much money. And what happens is, especially in a down year, people see that they lost. Their mutual fund has gone down, but the mutual fund still sold some stocks, maybe sold some bonds or whatever, got some interest, and still made money, even though the value has gone down. So they send the investor a 1099, and the investor has to pay taxes on that. Even though they didn't see any cash go in their checking account, they bought more shares. So they go to their Congress their Congress representative, and they say, this is not right. And every few years, actually, it hasn't happened in several years, so I really should change this slide. But the Congress makes noises about setting it up so unrealized capital gains, in other words, paper profits, would not be taxed until you sell your mutual fund shares. Forget it. That ain't going to happen. That would be an accounting nightmare. The tax code is already 9,000% more difficult than it should be. This would make it a nightmare, but it would make your CPA very happy. So, if it's in a tax-deferred retirement account, tax qualified, the IRS likes to say, then you pay no taxes until retirement. And then it's all taxed as income. Well, that makes sense. You didn't pay taxes on the way in, you pay taxes on the way out. The one exception is the Roth option. And we'll discuss these at the end of the semester in a quick presentation. Although this is something more that we discuss in the BUS123 Financial Planning and Money Management. The Roth option allows you to pay the taxes now and then not pay the taxes later. Very, very cool. Everyone should have a Roth IRA. And I'm not supposed to say that because we're supposed to know our client before we recommend any kind of investment, but everyone should have a Roth IRA, in my humble opinion. Okay, so you'll read this and quickly forget about it until you have to worry about it when tax time comes along, and I don't blame you because it's just, when I sometimes look at all the taxes that we have to do, and I just sometimes go lay down and take a nap and wait until I absolutely have to do it, and then I do it and get it done with. And it's kind of like going to the dentist, but there's no Novocaine. Now, where do we get information? Well, I already showed you the mutual fund websites, and we want you to use them because they're very useful. You're gonna part of your assignment for Chapter 2 is to investigate at least 2 mutual funds. Hopefully you'll do more because the one will pique your interest and you'll try to see one that's kind of similar or one that's exactly the opposite because you want to, it's an open-ended, folks. You got the rest of your life to study these things. You'll never study all of them because there's 12,000 of them out there. But the prospectus is the most important document of any mutual fund. And of course, it's the one that nobody reads. It's similar to the syllabus of the class, right? It's the most important document of the semester and nobody reads it. It's a statement describing the risk factors, description of the fund's past performance, the statement describing the types of investments in the fund's portfolio, information about dividends, distributions, taxes, information about the fund's management. Nobody reads them unless you've taken BUS123, Introduction to Investments, and it turns out that there's not a whole lot that you have to read. Much of it is legalese that you can just skim over. But they're very, very useful, especially if you have insomnia at night. So let's see if we can find a prospectus. Here we go. Here's a prospectus, and we'll take a look at a prospectus for one of the Vanguard funds. But this is a problem here. It's a real crazy. You go here and you get sipped from the fire hose. So let's take a look at the energy fund well, no, let's not do that one. The dividend growth fund. Okay, let's take a look at that one now. If you over here, whoa, I didn't mean to do that. That was a mistake. Where's the dividend growth fund? Let's move this over here and here. See, prospectus. Download it now. So if we take a look at the prospectus right now, what's going to happen? I didn't. I really should have. I should have. It opens up a new window, so forget that. Let's go to the one we're going to take a look at very soon, and that's ICA. So let's go to the summary prospectus. And so here, look at that. Isn't that something you want to read? But notice that should look familiar. Remember when we were talking about the fees of various mutual funds? The A shares, the C shares, the F shares, the B shares are gone. And there's all the different class shares, and we talked about that there are dozens of class shares. Remember all the information about the management fees, the other expenses, the 12B1 fees? It's all in the prospectus. And you read the prospectus, right? Ha 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 ha. And here, portfolio turnover. We talked about the portfolio turnover. Theirs was 39% during the most recent year. That meant they were doing some serious trading, not as much as this company usually does. They're usually about 25, 30%. They may invest up to 15% of its assets outside the United States. The fund invests primarily in common stocks, most of which have a history of paying dividends. So this is a growth and income fund. So I know it's too much information, and it's all in very small letters, and it's very hard to read. But we want you to at least slog through one or two of them, and actually two of them at the very least. And then once you get to the end, then you can start realizing that it's really scary stuff that only CPAs are interested in. But do your best to walk through. Here are the people who run the fund. So do your best to skim through it and familiarize yourself, because it's very similar to all the different websites you go to, and click here to say you've looked at the terms. Nobody does it. The one document that's a lot easier to read, and that's the mutual fund annual report. That's the old saying. The mutual fund annual report typically came out on very glossy, beautiful paper, expensive paper. The prospectus came out on cheap paper. And the old saying in the industry was, the more important information is on the cheaper paper. Now it's all electronic, right? People they download it and read it on their cell phone or whatever. So do read the annual report. This is where management, the mutual fund management, is going to try to put their best foot forward. And we're going to see the same thing when we start looking at stocks. We want to read at the very least, or listen to the very least, to what the management says about themselves, and realize that they're doing the best to put the best face forward they can, and then do some more digging. So you have plenty the rest of your life to go through all 12,000 mutant. Well, you're never going to do that. I'm not going to do that. But I have a cute little story. I was terrified of investing with these stocks because I knew that they were the best investments over time, but there's an awful lot of hanky-panky that goes on in our industry, folks. And I just didn't trust these mutual fund managers for the very reasons that we talked about. Many of them just don't beat the market. And I was working at a brokerage firm, and the president, small brokerage firm, I was a programmer. The president was the kind of investor I did not want to be. Buy and sell, and he had made a lot of money and lost a lot of money, and he was trying to make it back. And I would say, well, I don't know. His name was Frank. I don't know, Frank. It's kind of scary. He goes, you're not ready. He barked. And so I would talk to the second in command, Joan. She had been in the industry for many years, starting back in the 70s, and she could give you horror stories of what it was like to be a woman in the brokerage firm industry in the 1970s. And she showed me a mutual fund that had done well in good times and bad. She thought the management would be a company that I thought was good. And so she gave me the prospectus. And I took it home and I read the whole darn thing. And obviously, as I said, it's good for insomnia, but I read the whole darn thing. And I came back and said, now that's great. This is the kind of company I'm really interested in. Can you show me the other prospectus, the other mutual fund you were talking about? And she looked at me like I had three eyes in the middle of my forehead. And she said, you read the prospectus? I said, yeah, I read the whole thing. I'm going to put money with these people. And she looked at me and she goes, I don't know anybody who's ever read a prospectus. I've never read a prospectus. So that's what you're up against, right? That's what we're up against. They write it in such a way that they know people won't read it. But it's got good stuff in there, and you need to look at it. Okay. What about all the financial publications? Well, you got to be careful, folks. A lot of these publications are sometimes breathlessly discussing what's happened the last year, and that's not important. I want to know how well they've done 20, 30, 40 years. I don't care about the last year, the last 3, 5, or even 10 years. Some people say, well, 10 years is long enough. No, it's not. depending on what's going on in the marketplace. The last 10 years have been skewed toward growth-oriented companies. So if you were looking at an equity income fund because you wanted to protect on the downside, you look like an idiot, right? Your mutual fund is not done as well as the S&P 500 or that growth fund with the beautiful teeth and the gorgeous hair and on the cover of GQ and Vanity Unfair. But when the worm turns, as the saying goes, the equity income fund is going to hold its own. So that's what's happened actually just recently. Growth has gotten a major hit, but many people believe it's just temporary. We'll see. That's why they call it the future. So take a look at Lipper, Morningstar, Business Week, Forbes, Kiplinger's, and do your best to find other resources. Also, the mutual fund company itself, and Morningstar is not bad. I tend to say nasty things about them, but remember, when you're on Morningstar, every 5 minutes they're going to try to sign you up for $20 or $50 a month. Just say thank you very much. No, you can go to the library and get all the stuff that they won't give you on the website. You can get it all for free at the library. The financial websites that we talked about for the companies are actually very, very good, folks. So check them out. Morningstar, Business Week, Yahoo, but Morningstar and Yahoo are actually pretty easy to use. But check out Fidelity's, T. Rowe Price, Vanguard, Capital Group, Dodge & Cox, Franklin Templeton. All very, very good companies and very good websites. And then, as we said, the mother lode is the Investment Company Institute. That's a trade organization, a nonprofit trade organization, ICI.org. And that's where I got the data for the very first presentation about how many people own mutual funds and how much money is in mutual funds and the like. So, I don't know. I'm tired. And I already picked my mutual funds. How do you pick a mutual fund, Payano? I mean, come on. There's 12,000 and you've given us so many categories and so many things to think about. Well, for what it's worth, this is my advice. Pick a mutual fund that invests in high quality stocks or bonds, right? If you want a stock mutual fund, that means you're more interested in growth. If you want bonds, you're more interested in income and downside resilience, protection of capital. Is well diversified across several industries and sectors of the economy, and in my humble opinion, should be global, especially for younger folks, because the world is global. And I know some people are not happy about this, but there's only one world. A mutual fund that has a long-term perspective and a manager, or better yet, in my humble opinion, a management team with many years of experience. And these are the companies that I really like. Companies that work as a team. But it's not a committee. They don't all have to decide on one company. They can differ in their opinions. One mutual fund manager might be buying Home Depot, and the other manager might be selling it and saying, I think it's a great. One person saying, I think it's a great deal. And no, I think it's too overpriced or whatever. And that creates that dynamism within the mutual fund company. I'm a big fan of that. But there are individuals who run the mutual fund on their own and do a very good job. So there's chocolate and vanilla, and some people like strawberry. But what you really want to do is avoid companies that shuffle their managers like a deck of cards every few years. Now, this was Fidelity 20, 30, 50 years ago. Most companies realize now that that's not the best way to run a mutual fund. Why? Because look, these people are not stupid. They're the best of the brightest coming out of the business schools, and they see what goes on. And more it's not going on, thankfully. But they know that if they stick around, if they do well in the first 2 years or so, 18 months, 2 years, they're going to be showered with love and attention and a whole lot of money and get to keep their jobs. If they don't do well, out the door. So they will typically, or they did in the past, it's changing thankfully, they would take bigger risks than normally would be prudent to take, because they knew if they did well, they get to keep their jobs, and if they didn't do well, they're going to get fired anyway. And the old man of Fidelity, he's long since dead, my apologies, I'm not trying to say ill of the dead, but this was his modus operandi. He said, look, they need to produce. And it produced people like Peter Lynch, which, hey, congratulations for the people who invested in his fund. But it also produced people that didn't do such a great job. And so that's why I'm not a big fan of that. But you'll see it less and less. Fewer and fewer mutual funds are doing this. But this is the biggest criteria. The company, a mutual fund that's been around for decades and performed consistently well in good times and bad times. Why? I don't want to know how well you've done in a good time, right? Any idiot, myself included, right, can do well in good times. I want to know how well you did when the organic matter hit the ventilating device, because it's going to happen. We know it's going to happen. We know time to time the markets are going to fall. How well did you hold up during those times of falling? And one of the measurements I want to ask you to look for is the downside capture ratio. It's very cool. It's one of the cool things that Morningstar does. It shows you how well they did on the upside. That's the upside capture ratio. How well they captured when the market's going up, but how little they captured, or how much they captured of the downside when the market goes down. So that's, my humble opinion. These are the criteria I look at when you're picking a mutual fund, realizing that other people are going to say, no, we want growth, and then when the growth starts to stop, we're going to move it on to the money market. Well, good luck with that. Good luck with that. I wish you a lot of luck. I ain't going to even try. So, where do we start? Well, we start with a sample mutual fund that has been around for over 88 years. Is that long enough for you? Remember when we discussed stocks, we said 8, 9, 10%, right? If we get 8, 9, 10%, we're very happy. Well, this one's done 12% over 88 years. And in the face-to-face class, this is where we would jump to the mutual fund. But it's here, folks, and I really want you to look at it, folks. It's called the Investment Company of America. It's been around since, actually, it started back in the 20s, but in January, actually December 31st, 1933, they took over. So it starts January 1st, 1934. And this is a discussion of how well, it's an illustration of how well they've done. And it doesn't look good in this venue. So there's a video and an audio and a commentary and the top 75 holdings, the benefit of time, worst day, best day. So I submit to you that you really do want to look at it, because if we click on it now, it's not going to look very good. But this illustration, we go through this illustration, so please do check that out. Check that presentation out where we've set it up so it'll look better on the screen. And then check out the top 75 holdings. What kind of companies? This is a domestic stock growth and income fund. Not what I normally recommend to new individuals. I usually pick a global one, similar to this, but one that invests globally. What's the benefit of time? How well have you done if you held your money over 3, 5, 10 years? And then what if you picked the worst day to invest, and what if you picked the best day? So please do go through these presentations, these commentaries, and they're on the website, they're in Canvas, and I do hope you will see them, because the news is good. This company took $10,000 and turned it into how much? How much? Well, okay, all right. I won't keep you in suspense. Let's see if we can just find the number. It's way at the bottom. It turned 10,000 into 246,340,000 and $279 at 12.18%. Now remember, we tell people 8, 9, 10%. We don't want to get them overly excited, right? But here's one company that's done 12% over 88 years. And we find that stocks are very risky in the short term, because there's been times when this mutual fund has fallen 40, 50%, folks. And when this mutual fund falls 40, 50%, other mutual funds fall 80%, the 70%, the aggressive growth funds. And if we have a long-term perspective, we find that, stocks are really not that risky if we're able to withstand the volatility. And of course, if the world doesn't end. If the world ends, doesn't matter where your money is, right? Also, you'll hear people say, well, it's not a good time to invest. When is it really ever a good time to invest? The old phrase, Wall Street climbs a wall of worry. This one presentation shows you how well you had done if you had picked the worst day and if you had picked the best day, and it turns out the difference isn't really that big. It's time in the market, not timing the market. And then what about the market downturns? Well, they're going to happen, folks. There's no way to stop them. You could try to get out before it happens, but good luck with that. It's called market timing, and it can only be done by liars, according to a very famous investor, Bernard Baruch, of 100 years ago. Keep a long-term perspective when the markets fall, and dollar cost average. Now, there's that term again. What does it mean? Well, a dollar cost average is actually a very simple technique. It's a horrible name, and I've been trying to come up with a better one. But it's a system of buying an interval at a system of buying an investment at regular intervals with a fixed dollar amount. You see, the cool thing about dollar cost averaging is no matter what happens when you wake up in the morning, there's always good news. And that's what I was convincing my wife, a long time ago when I first met her, because she was terrified of stocks. The market's up. Good news. Yippee. Your account's worth more. Your $100 is now $100.20 or whatever. The market is down. Good news. What? What? Next month. Yeah, think about it. When do you want to buy shares? When do you want to buy something? When it's on sale or when it goes up 100%? You're going to get more shares at a lower price when the $50 or $100 comes out of your paycheck or checking account. Right? Doesn't that make sense? In fact, the best thing for you young people is that the market crashed 80%, assuming the world doesn't end. Because, right, you're going to be putting money in over the next 30, 40 years. And so, but no, we don't want that to happen because that means people are out of work and a lot of bankruptcies and the like. We want everybody to be successful, realizing that capitalism, everybody's not going to be successful, but we do our best, right? We root for everybody, except for Microsoft. I don't want Microsoft to be. That's a long story. Anyway, there's a saying, there's a fact about this that I want you to remember and memorize. We'll come back to it later. So if you don't do it now, that's okay. We'll come back to it towards the end of the semester. Your average cost per share should be lower than your average price per share. Huh? Well, because you're buying more shares when the price goes down, fewer shares when the price goes up, you wind up spending less on a cost per share basis. Now, it's not a guarantee. Dollar cost averaging isn't going to make a lousy investment a good investment automatically. Oh, it keeps going down. I'm buying more shares. Yippee. But it's about as brain dead simple of an investment technique that you can imagine. And as we said, it's practically the only way we working grunts are going to invest. $50 out of our checking account, $100 out of every month out of our paycheck into a 401k, and then they match, which is very cool. Free money. I know it makes investing boring, but it works. Now, the industry has what are called hypotheticals, hypothetical illustrations. They are examples of returns of investments for either a lump sum principal. Yeah, the SEC uses $10,000. I don't know why. How many people have $10,000 lying around the house? Or a stream of investment. That's another name for a dollar cost average, which it sounds poetic, a stream of investments, but I think it's about as bad as dollar cost averaging. Or a combination of both. Now, they must be approved by the Securities and Exchange Commission and Financial Industry Regulatory Authority, FINRA. They must contain disclaimers about past versus future performance. So in the face-to-face class, we would now look at some of the hypotheticals. And so not everybody, as we saw the 88 years of, not everybody has an 88-year time frame. So what we did is we did five different illustrations. $100 a month for 30 years, $100 a month for 40 years, but then the best one, $100 a month for 40 years, and every year we increase by $10 every year. Is that cool, right? First year, $100 a month, next year, $110 a month. 2 fewer trips to $5. I'm sorry, $6. Starbucks. Can you pull that off? Next year, $120 after that. As your income grows, as your debts get paid down. And that's great for the people in their 20s, 30s, and even into their early 40s. But what happens when you get into your later 40s, 50s, 60s? Oh, the news is not as good. You need to put $500 or $1,000 per month away. And that sounds like a lot of money, but that's what some people pay on their cars after they pay the payment and then the insurance and then the maintenance and the gasoline. So get a bicycle. Anyway, go through the presentation. Please, please, please. Again, this is not the best venue in this setting. Doesn't look as good. And then look at what happens when we discuss the A shares versus the FRI shares, the fee-based, the assets under management. Take a look at that. Remember we talked about that back in the second chapter. This is somebody who has a $500,000 whatever, nest egg, or maybe they got a settlement, or maybe they won the lottery or whatever. And they go with paying the upfront fee versus a annual assets under management fee. So please, please, please go through those because the news is good. You, a working grunt, can build substantial wealth through mutual funds, well-run mutual funds, long-term oriented, prudent investing, assuming the world doesn't end. So you might be thinking that I'm trying to get you to buy Investment Company of America, but that's not true. I'm not trying to sell that one mutual fund. We picked that mutual fund just because it has an 88-year time frame, and it's actually been a very good mutual fund. It's not the best, it's not the worst, it's certainly in the upper tier of mutual funds. But it ain't the only one. All of these mutual funds. Now, I'm not the best when it comes to graphics. It used to be better because I could turn it into a picture, into a JPEG graphic file. But we're told we really shouldn't be using those, and so I did it text-based, and now they're all tiny. I tried to make them bigger, but they don't fit on the screen. And maybe I'll get rid of a few. I'm not sure. But if anybody is graphically oriented and is interested in helping, please contact me. But you probably, if you're looking at this on a phone or whatever, you can't read these. But here they are, folks. These are all mutual funds that have been around for over 50 years and have done better than 10%. Look, some of them 11, 12%. There's the Fidelity Contra Fund, which is an excellent fund run by a very, very smart man. But he's getting up there like me, so I don't know what's going to happen. Notice all the Fidelity funds. There's the American funds, and Dodge and Cox, and T. Rowe Price, and Templeton, Vanguard. So these are companies that have been, Franklin, companies that have been around for decades and have done well in good times and bad times. Now, the one we want to point out is Fidelity Magellan. Look at that, 16.25. That's not good. We shouldn't really include Fidelity Magellan. Why is that? That's because of between 1977 and 1990, Peter Lynch ran up 29% a year. Yeah, no, it's not going to happen. Maybe who knows what's going to happen? But it's the future. We don't know the future. But since then, it's never reclaimed its glory. But look at this, the income fund. This is basically like an equity income fund. Equity income funds have no business making over 10%, but the Franklin Income Fund has. There's an equity and income fund, so I'm not exactly sure what Invesco's pulling off. Remember, they used to be Oppenheimer. But there's the Investment Company of America, the one we just looked at. And look at it. It's pretty amazing, isn't it? These are companies that have been around for 50 years. Now, you'll notice that most all of these companies, and if you don't notice, I'll tell you, are based in the United States. They're mostly all domestic mutual funds. And why is that? Simply because the global mutual funds just haven't been around that as much longer. There's one here, the Templeton Growth Fund, that's been around since 1954. That was one of the first mutual funds that went outside the United States. And in a couple of years, there'll be a few that have done better than 10% that have been around for more than 50 years. But the news is good. Then there are many good funds run by people who have a long-term, prudent orientation looking at it for an eye for growth and of capital and income, and can build a lot of wealth for you, dear students. Unless the world ends. I think I've said that already. But what about the investors? Slide 77. What type of returns do many typical mutual fund investors earn? Not so good. What? There's a saying in the industry, and it's true. Most mutual fund investors do worse than the mutual funds they invest in. How can that be? How can the investors do worse than the mutual funds that they invest in? It's actually very easy. They wait until the market's gone up 100%, then they yell out, who is it too late to get in? And then they buy high, and then, of course, just in time for the market to crash, and then they sell low. Ooh, is it too late to get out? Investing is simple, but it ain't easy. The emotions destroy us. And so here, this is going to be hard for some of you to see, especially if you're looking on your phone, but get to a computer and enlarge it. And you'll see that at the year 2000, the market had gone, for the last 10 years, actually almost 20 years, in two directions, up and way up. And the market hit its peak March of 2000. Notice they grew these little, I think they're like bluish gray or whatever. These are mutual fund inflows. The yellow is the market performance. So notice that the market hit its peak, the yellow, at March of 2000, but the inflows into the mutual funds just skyrocketed because the market had gone in two directions, up and way up. Ooh, is it too late to get in? And then we had 2.5 years of down until 2003, and it wasn't until just at the market at its bottom, people started pulling their money out of the mutual fund at the worst possible time. The market then skyrocketed in 2003, and what did people do? Put their money back in. People buy high, sell low, and then here's 2008, where the market literally crashed, and then people pulled their money out at the worst pot. That was the time you're supposed to be putting the money in. It comes back in 2009 and 10, and people took until 2013 or so to start putting money back in. So you see, that is why we emphasize over and over again that you cannot let emotions rule your investing, because you're going to wind up like these poor fools. Souls. You're going to buy high and sell low, and we don't want you to do that. It's just anathema. I'm not sure if I'm saying that right. It's very bad. Muy malo for your finances. The bad times are a time when you just turn the television off, turn off the internet, just go out and play volleyball or chase the kids or whatever, and make sure that $50 or $100. And if you have more, that's the time to put money in. But who wants to put money in when the market's falling? Ugh. Investing is simple, but it ain't easy. So, slide 78. What's the bottom line? Choose a fund family and stick with them. Reevaluate your mutual funds periodically. Once or twice a year is enough. Once a year. But make changes judiciously and sparingly. You like that word, judiciously? As you approach retirement, migrate from stock funds to bond funds. But don't give up on stocks entirely. We'll discuss that later on. People are living longer in retirement. They need some growth. And dollar cost average. $50, $100 a month, more if you can afford it. But for the most part, forget about them. Once you've made your decision, or you've had somebody help you make a decision, let the mutual fund do its job. Do not be one of the mutual fund investors that does worse than your mutual funds. And that is our discussion of mutual funds, investments for the masses. Very important information, folks. And if you don't go any further in this class, at least you are ready to tackle your 401k choices, your Roth IRA choices if you use mutual funds, But oh my goodness, we want you to continue. Why? Because now we're ready to get involved, to introduce ourselves to stocks. Exciting stocks, sexy stocks, risky stocks. Once again, we thank you very much for being in our class, and we are so proud of you. See you in our next chapter when we start our long march toward learning to invest in individual stocks, businesses, corporations. See ya.